As an entrepreneur that is steering the ship of their own business, you know how important it is to navigate the financial waters effectively. In this video, I'll be sharing 5 financial metrics that every savvy business owner should know. And in case you're a startup business owner or a seasoned business pro, you will find these financial metrics valuable on your journey to financial success. If you're seeing me for the first time, my name is Bukola Oshashono. I teach bookkeeping, accounting, and financial literacy tips to help business owners and individuals. So let's dive into today's topic. 5 financial metrics that every savvy business owner should know. And number 1 metric is profit margin. Profit margin. What is profit margin? Profit margin is a generally adopted measure of the profit-making capacity of any business. Hope that doesn't sound confusing. Let me break it down further. So profit margin seeks to know the percentage of profit in every revenue made. For every 1 naira of revenue made, we want to know the margin of profit in that revenue. So the 2 parameters that are used to calculate profit margin here, the profit and then the revenue. So let's put this in a clearer perspective. Let's use Lara, a baker, as an example. Lara charged her customer 25,000 naira for a birthday cake. After calculating all her overhead expenses, cost of transport, everything amounts to 16,000 naira. If we deduct all expenses from the 25,000 naira selling price of the cake, we have 9,000 naira as the profit. So what is Lara's profit margin? All we need to do is to divide the profit by the selling price. The profit on this cake is 9,000 naira. The selling price is 25,000 naira. So you have 9,000 divided by 25,000 naira. And this gives you 0.36, which is 36%. Profit margin is calculated in percentage. 36% is Lara's profit margin on that cake. I hope you understand that. Please put it in the comment section if you now understand what profit margin is. So from henceforth, if anybody walks up to you and asks you what your profit margin is, you already know that profit margin is a percentage of revenue that represents your profit after taking off all expenses. So let's go on to metric number 2. And metric number 2 is cash flow. I'm sure you must have heard the saying before that cash is king. Cash flow is simply the net amount of cash and cash equivalents moving in and out of your business. Net amount of cash and cash equivalent, that is cash that is coming into the business and cash that is moving out of the business. Managing cash is essential for the health and survival of any business. In a retail business, even in a month where you have slow sales, if cash flow is managed efficiently, you'll be able to pay your bills and other utilities on time, and your business will still stay afloat, even though it is a slow month for sales. Cash flow management is really important for any business, and these are some of the practical ways by which cash flow can be managed. Number 1 is to create an accurate cash flow projection. In accounting, there is a statement that is called a cash flow statement, and what this statement does is to help you to know the list of all the inflows, the cash inflows you'll be having for a certain period, and the outflows you're expected to pay, the cash that will come out of that business. So you're able to manage, you're able to see a period where there is surplus or deficit, and then you're able to make decisions on what to do to avoid being cash trapped in those lean periods. You can negotiate favorable credit terms with your suppliers. Maybe you buy your goods and you pay your suppliers like 3 days after. You can negotiate for an extended period, let's say a week or 2 weeks. This will help you align your outgoing payments with incoming revenue and therefore helping your cash flow. Cash flow is an entire topic on its own, and I hope one of these days we get to make a video on cash flow. Let's move on to metric number 3 for today, and the metric number 3 is returns on investment. Return on investment, as the name implies, measures the return on an investment relative to its costs. What does this mean? Return on investment is a performance measure used to evaluate the efficiency of an investment. Using Lara as an example again, let's assume Lara decides to invest in a bigger oven for her baking business, and this oven costs 1 million naira. And this oven has the capacity to generate a profit of 300,000 naira per year. What is Lara's return on investment? Lara's return on investment would be the 300,000 naira profit that the oven will generate at the end of the year. That's 300,000 naira all over the cost of that oven, which is 1 million naira. And this gives us 30%. Like profit margin, return on investment too is calculated in percentage. So as a business owner, you want to invest in any equipment, you want to expand your business, it is important for you to know the returns on investment that equipment is going to generate. So we move on to number 3 metric, which is debt equity ratio. Debt equity ratio. So what this is saying, as the name implies, is that we want to measure the ratio of debt to equity. So what percentage of the business is being financed by debt and what percentage is being financed by equity. What debt equity ratio does is to compare a business total debt to its equity, knowing the proportion of the financing that comes from debt. I explained the element of accounting in a video and I've put the link in the description. Please, you can click on the video to watch it to have a better understanding of equity and liability. So let's take, for instance, a business is financed by 1 million naira debt and by 500,000 equity. What is debt equity ratio? Debt equity ratio is 1 million naira divided by 500,000 naira, which gives us ratio 2:1. That means debt is ratio 2 while equity is ratio 1. So if anybody asks you what is your debt to equity ratio, know how to calculate this already. Now we move on to metric number 5, and this is customer acquisition cost. Customer acquisition cost. It is good to acquire new customers for every business. This is the dream of every business owner, but it is also important to know the cost of acquisition of each customer. So let's assume in expanding Lara's baking business, she makes some marketing related expenses like social media expenses, like advertising on social media, advertising on radio, jingles, printing bills, printing flyers, and this amounts to 100,000 naira. And at the end of the day, she was able to get 10 customers. So what is the customer acquisition cost? Is simply dividing the 100,000 naira marketing expenses by the number of customers she was able to acquire. That is 100,000 naira divided by 10 customers. And what does this give us? This gives us 10 naira per customer. So the importance of customer acquisition cost is to help you evaluate your marketing efforts. Maybe you need to change your strategies or you need to stick to it. Understanding these 5 financial metrics will empower business owners to make decisions that will lead to the financial health and the sustainability of their businesses. If this video has inspired you, please give me thumbs up. Please write the financial metric that stood out for you into this video. Until we meet in my next video, keep on flourishing. Thank you for watching. Bye.